How's it going, YouTube? My name is Ari and welcome to Blue Lion Finance, a channel dedicated to investing in my personal journey to amassing $100,000 within my Vanguard brokerage account. Now, what a heck of a week it has been with all three composites on the up and up, from the S&P 500, Dow Jones, and NASDAQ all in the green. That Santa Claus rally is very much real. Now, my account is currently sitting at $84,405.84. That is up by $2,029.07. Now, I'm expecting we're going to end the year in green here, but in today's video, what I want to get into is that macro level view of what's going on in the market so you can be best prepared entering 2022, and then most importantly, get on with it into the 5 high quality dividend stocks that are still heavily discounted here that you can pick up just before the year ends. A video you're not going to want to miss out on. Before we actually go ahead and dive in, tap on that thumbs up button as it helps me grow this channel and get the word out there. And of course, if you haven't done so already, go ahead, tap on that subscribe button while you're at it. I'd certainly love for each and every one of you to be on this journey with me. Now, YouTube, let's go ahead and dive right in. So here we are now coming up on the end of the year, and I want to get right to it and just talking about this macro level overview of what's happening in the market because, well, I hate to be the I told you so guy, but
I told you so.
And sharing with all of you that we're going to be ending 2021 in the green. That is exactly what's happening. And how exactly did I predict that? Well, just taking a look at a lot of the data that's out there, we can expect that the Santa Claus rally was going to kick in. And of course, this builds a lot of momentum heading into the new year. Now, the Santa Claus rally, something we're currently experiencing right now, is a rally that happens building momentum into a new year. It was coined back in the 1970s, but the data goes all the way back into the 1950s, sharing with all of us that 78.9% of the time, investors at the end of the year get very excited. And of course, we get overall beautiful returns with our investments. Now, there have been 6 times since the 1990s that this was not the case, but once the momentum is seemingly built, it just continues on right into the new year. Now, here's where we pull back and take a look at the bigger picture, because it's most important to understand that we still have COVID cases on the rise and inflationary scares up the wazoo, which ultimately means that this rally will come to an end and we should all be on our toes for that. However, at this point in time, there are many stocks that are out there, 5 of which I'm going to share with you in today's video, that are still undervalued. You can pick up on a heavy discount to end 2021. And if you're that long-term value investor, that's all you have to do is invest into these companies, hold on to them for the long run as the value of that stock goes up. And of course, you get to collect on dividends along the way.
Oh yeah, it's all coming together.
Now, this all leads me to the very first stock I want to talk about today, which is Johnson & Johnson, ticker symbol JNJ. Now, Johnson & Johnson has 130 plus years worth of history of revolutionizing the entire healthcare industry since its founding back in 1886. It's certainly not going to be disappearing anytime soon, but in recent news, we can see here that Johnson & Johnson stock actually fell from around $180 per share down to around $168 per share, which presents about a 7.1% flash sale opportunity for all of us longer term value investors to get our hands on Johnson & Johnson at a lower valuation. Now, just taking a look at Johnson & Johnson's stock and the company as a whole, what went wrong to make Johnson & Johnson's stock share price fall? And honestly, big picture thinking here, nothing. But 2 factors actually stand out to me which have been impacting Johnson & Johnson's stock share price. The very first factor is that after they came out with that single dose vaccine, we had Pfizer and Moderna going head to head throughout the year, and Johnson & Johnson took more of a backseat role here just because a lot of data poured out about blood clotting issues and adverse effects, and that of course scared a lot of investors away. And then throughout the entire year, with all of this money being printed by the Federal Reserve, I just believe the market conditions called for a lot of investors to be YOLOing their money away or just gambling more of their money into higher stake opportunities that were out there. But coming into 2022, I think the tables are going to be turning, and go figure, fundamentals will absolutely matter once again, which is why I think that Johnson & Johnson is just going to continue to rise well into 2022. Now, analysts believe Johnson & Johnson is going to continue to rise, coming in at a median stock share price of $180 per share and a high stock share price of $215 per share. Now, ultimately, ultimately, again, as long-term value investors collecting on dividends, we get to collect on Johnson & Johnson's dividend, which they've been paying out now for nearly 60 years, increasing that dividend year over year with their current dividend yield sitting at 2.52%. Now, with Johnson & Johnson's recent news of their rollout of their consumer goods segment into its own business, leaving the medical device segment as well as their pharmaceutical segment binding together, I believe this is just going to be a powerhouse of a play moving well into 2022 and beyond. Next up, we have Cincinnati Financial Corporation, ticker symbol CINF. Cincinnati Financial is an insurance company that is primarily focused on casualty and property insurance. Most importantly to understand about Cincinnati Financial is very similarly to Johnson & Johnson. It has just been an incredibly safe play throughout the year, not something that a lot of investors have been taking a look into as we've been YOLOing away a lot of money on higher stake stock opportunities. However, Cincinnati Financial is creating a beautiful case for us rather recently to get invested into it heading into the new year. As of recently, their stock share price actually fell from $126 per share to around $112 per share. That's about a 12.5% opportunity for us to buy Cincinnati Financial at a lower valuation, a beautiful opportunity to get our hands on it. Most importantly is that throughout the year of 2021, they have been super focused on actually going head to head with some of these newer startups like Lemonade and Root to take these companies on, because as the insurance industry is due for a disruption when it comes to AI, Cincinnati Financial wants to make sure it is ahead of the game, which is exactly where it's been investing. Now, looking ahead, which is exactly where analysts are looking, we can see that Cincinnati Financial is due to continue to rise, coming in at a median stock share price by analysts' expectations at $130 per share and a high stock share price of $151 per share. So certainly not only just room to rebound, but continue to grow for Cincinnati Financial. And most importantly, as value investors looking for that dividend, here we are with Cincinnati Financial paying those dividends out for 61 consecutive years, increasing those dividends year over year with a current dividend yield coming in at 2.24%. Now, this is quite a steal for the long-term value investor. Moving right along to our third stock opportunity, we have a Fortune 500 company that was founded back in 1890, so certainly has been establishing itself as an industry leader in its own right. This company is Emerson Electric, ticker symbol EMR. Emerson Electric is a manufacturer of products, that being process control systems, valves, analytical instruments, as well as providing engineering services to industrial, commercial, and consumer segments. Now, all along the way here throughout 2021, Emerson Electric has been building a backlog of sales, and of course with the supply chain disruption, it has certainly been hit and impacted. We can take a look at its stock share price as it fell from $105 per share down to around $91 per share. That's about a 15.4% opportunity for us to pick this stock up while it is currently on sale. Now, all in all, with about $5.4 billion worth of sales throughout 2021, I only really project that a company like Emerson Electric is going to continue to do very well moving into 2022, especially as a lot of companies move forward with automation. Now, analysts have those very same presumptions as they're coming in at a median stock share price of $106 per share and a high stock share price of $125 per share. Now, ultimately, with Emerson Electric being a dividend king with 65 consecutive years worth of dividend payments and increases along the way, and their current dividend yield sitting at 2.29%, Emerson Electric is certainly ripe for picking for any dividend investor's portfolio. Now, next up, we have Leggett and Platt, ticker symbol LEG. Leggett and Platt is a company that a lot of dividend investors have been talking about rather recently, and rightfully so. Heading into 2022, it is certainly ripe for picking. Leggett and Platt is a diversified manufacturer of various engineered components and products that are often found throughout your house or your car, talking about car seating, flooring, furniture, you name it. Leggett & Platt is probably a part of that manufacturing of a lot of those products. And of course, while not the sexiest company to invest in, certainly one that has been around for 138 years and has been very lucrative of an investment for the dividend and value investor out there. Most importantly to understand, again, is that it has been impacted by the supply chain disruption as well as labor shortages, which have certainly made for a miss on their earnings in November, and their stock share price plummeted from from $51 per share down to around $39 per share, and ultimately creating about a 30% opportunity for all of us to go in and buy this company while it's on sale. Now, for a company like Leggett and Platt that is an absolute necessity for us all, it is not going to be disappearing anytime soon. So analysts, of course, expect it to rebound. Coming in at a median stock share price of $51.50 a share and a high stock share price of $55 per share. Now, as a dividend king, paying out 50 years worth of dividend payments and increases along the way, and their current dividend yield sitting at 4.26%. You better believe Leggett and Platt is certainly a wise investment moving well beyond 2022. And last but not least, in my opinion, now we have the best discounted stock that we can possibly get our hands on at the end of 2021 here. That is Medtronic, ticker symbol MDT. Medtronic is a medical technology company that was founded back in 1949, has not stopped revolutionizing the industry in terms of medical devices since its founding. And rather recent news, its stock share price took a beating, falling from $135 per share down to around $100, $101, $102 per share. Last week, even dipping below $100 per share. That is about a 32% opportunity for all of us to buy this stock while it is on sale. Taking a look at what exactly has happened to Medtronic over this period of time, we can see that they missed on their earnings report. On top of that, we had COVID cases spiking, putting off elective surgeries. Go figure. That's not the best news for a company focused on medical devices. And then, of course, just the market conditions of labor shortages as well as supply chain disruption issues. Medtronic has not fared well, and then as of December 15th, the FDA came out with a warning against Medtronic's facility that is manufacturing diabetes devices. So all in all, Medtronic certainly has not been faring very well rather recently, but in my personal opinion, the market is just overreacting based on fear and uncertainty. That is exactly what we always do, but analysts tend to agree with me here on that overreaction, now coming in with a median stock share price for Medtronic at $138 per share and a high stock share price of $153 per share, as well as a company that's been paying out dividends for 44 consecutive years with a current dividend yield at 2.49%. Medtronic is going to be here to stay and here for the long run. So a perfect opportunity to get your hands on a heavily discounted stock opportunity that can deliver a ton of value to any dividend investor's portfolio. Hey YouTube, that is it. Those are the 5 high quality dividend stock opportunities I suggest each and every one of you to take a look into prior to the closeout of 2021 and well into 2022. Now, if you yourself, you like what you heard, you learned something new, drop those comments below. I'd absolutely love to read through them. Understand that I'm not a financial advisor, so just do your own due diligence prior to investing into any of those stocks. And of course, before we close out, tap on that thumbs up button, help me grow this channel. If you haven't done so by this point, tap on that subscribe button while you're at it. I'd certainly love for you to be on this journey with me. And until the next video, YouTube, I will see you all there.